This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, up until now, what we've seen is that when a company disposes of shares in another company and either a chargeable gain or allowable loss needs to be computed, our problem is determining allowable cost. It's been an issue of applying the identification rules as regards shares, knowing that when some shares are sold out of a shareholding, which shares are being sold. Unless you know which shares are being sold, you cannot determine cost. And if you can't determine cost, then you cannot compute the gain. You need a cost figure to go against your sales proceeds to give you, at least for a company, an unindexed gain. So we've seen those procedures. But what we look at now is, well, a very different outcome in terms of a disposal of shares by a company in another company. And it is, of course, the situation of takeovers. Now, if you recall what we did when dealing in Chapter 13 with takeovers, there the only difference was that the shareholder was an individual, now the shareholder is a company. If you understood the procedures that we adopted there, then there is nothing that is difficult about what we are now going to do. We simply got a new add-in to the problem. Techniques, the principles that we apply to deal with the problem is the same, but the add-on problem is, we have indexation allowance to deal with when computing a chargeable gain when a disposal is made by a company. Not a problem, of course, that we experience for individuals. So how do we deal with this? Let's remind you, therefore, of what might happen in terms of a takeover. Certainly in terms of the takeover that you would have to deal with in terms of any examination question here. Where we have a takeover, we're going to see a share-for-share deal. Share-for-share, sometimes known as paper-for-paper transaction. Shareholders of the company taken over acquire shares in the acquiring company. Well, this normally does not constitute a chargeable disposal. We get what we know as share-for-share relief. So what it means is, if you exchange your shares, bits of paper held in one company, for shares now held, other bits of paper in another company, the takeover company here, then no gain has crystallized. There's no cash. You've just swapped bits of paper. It's a share-for-share transfer. That will mean that no gain will crystallize at that point of takeover. But of course, when will a gain crystallize? When eventually you dispose of your new shares in the new takeover company at some future point in time. And when those shares are sold, there will be sale proceeds and you'll need to know the cost. The problem, you never bought those shares. You acquired them as a result of a takeover based on shares that you had held in a different company, your original shareholding. So we get a situation where, for example, we have A Limited owns 10,000 shares in V Limited. Cost £100,000. We're now told that V Limited is taken over by Villa PLC. Now, of course, this takeover is going to be on a share-for-share deal, and so what we discover, of course, is that we're told that the terms of the takeover are that A Limited receives 2 shares in Villa for each V Limited share held. So A Limited owns 10,000 shares in V Limited, and they cost A Limited £100,000 when originally purchased. V Limited is taken over by Villa PLC, and what are the terms of the takeover? A Limited, the shareholder, receives 2 shares in Villa for each V Limited share held. So what we've got to do is a very simple analysis. We simply have to establish how many shares A Limited now owns in the new company, Villa plc, and those shares will acquire the same original cost of the original shareholding that A Limited had, i.e. A Limited had 10,000 shares in V Limited, cost £100,000. So following the takeover, what will A Limited have? Well, it owned 10,000 shares in V Limited. And for each of those shares, how many shares did it get in Villa plc? 2 shares equals 20,000 shares. Now at this point, the market value of those shares is not an issue because there is no gain that crystallises because A Limited has not received any cash, it's just received other bits of paper. It's received 20,000 shares. And those 20,000 shares, this rule applies. The new shares are deemed to have been acquired for the same cost as the original shares. The original shares, A Limited owned shares in V Limited, they cost £100,000. So what now happens is A Limited instead owns 20,000 shares in V plc, which are also deemed to have cost £100,000. So that when any of those 20,000 shares in Villa plc are sold in the future, you will know that they will be deemed to have a cost of £100,000 incurred at the point in time when A Limited had originally acquired its shares in V Limited. And that will allow you then to apply an indexation factor to the cost, either up to the date of disposal or December 2017, rather more likely if that be an earlier date, so as to then work out the chargeable gain that arises when A Limited disposes of the new shares that it acquired in Villa plc. So the 2 points of contact with the tax system that you have to be aware of. At the time of takeover, if it is a share-for-share transfer, no gain crystallises, share-for-share relief applies, which means that the new shares, 10,000 times 2, 20,000 shares now held in Villa plc, those new shares step into the shoes, as the old saying goes, of the old shares. So they are deemed to have cost £100,000. So at the time of takeover, no gain crystallises, the new shares take on the cost of the old shares. What then happens in the future? Some of those new shares, i.e. the Villa plc shares, are sold by A Limited. When they are sold, you know the sales proceeds, you need to know the cost. Well, the 20,000 shares were deemed to have cost £100,000. You will then be supplied with an indexation factor or factors, from which you will choose to select the correct one there, being from the date when the shares in V Limited were originally acquired, that's when the cost was incurred of £100,000, all the way through to either the date of disposal, but if that is happening now in 2019 or 2020, as the case may be for you, then it's December 17 when indexation allowance will apply to. Now, what normally happens is that the terms of the takeover are a little bit more interesting than the example I have just given you there. And that's what we see now in Part C of this note, that a takeover may involve attributing the cost of the original holding, in our example, that was £100,000, to different component parts of the new holding. Because what we might get is a mix of consideration. Here we acquired one type of share in Villa plc, no doubt ordinary shares in Villa plc. But what we're prone to get, what you're likely to see in an exam question, is that we get a mix of consideration being received. And that most likely mix is a combination of ordinary shares and preference shares in the takeover company. So that means that our cost figure of our original shareholding, there it was £100,000, cannot now all be attributed to one single shareholding. A moment ago it could. We got, for example, just ordinary shares in Villa plc. But now we have received two different types of share, and they will go into and form their own share pool. For ordinary shares, separate share pool for preference shares. And any one of those shareholdings could be disposed of in the future, and for it you would need to know its relevant cost. So what that means we now need to do at the time of the takeover is to split that cost here of A Limited shares in V Limited between the two types of share acquired, the ordinary shares and the preference shares. Clearly, therefore, we need to know a basis by which we will split. We will allocate that original cost of shares in V Limited to the new shares, both ordinary and preference, that you now acquire in the takeover company. How do we do it? This is done by allocating the cost of the original holding, here the £100,000, to the new shares according to, here's the critical thing, the market value of what was received at the time of the takeover. So you would be told what was the market value of the ordinary shares, what was the market value of the preference shares at the time of the takeover. So you would do simply what we've done here. You'd owned 10,000 shares in V Limited. You got two ordinary shares in Villa plc for each V Limited share that you had held. And that would give you 20,000 shares. And they then tell you the price per share. It might be £6 per share. 20,000 times 6, well, that would be £120,000 of market value. They would then also tell you how many preference shares you had acquired for each share that you held in V Limited. And you multiply that out. 10,000 shares in V Limited times however many preference shares you acquired in Villa plc. And you'd be given a separate price per share at that point of takeover of the preference shares. You'd work that market value, and you would use those market values as a basis for dividing out the original cost of your original shareholding here in V Limited. So that 100,000 would be split proportionately between the ordinary shares in Villa and the preference shares in Villa. And once you know those respective costs, should you have a disposal of any of those shares, whether ordinary or preference, if you have a cost, you can work out an unindexed gain. If you have a cost, you can work out indexation allowance, and the job is complete. Right. What we've got, therefore, is example 4 now to pursue to deal with this, and we'll work this through together. As you'll probably see, as I've scribbled in here, there's just a change in a date that needs to go through. So hopefully what you've got is a version of this question in front of you that has already been updated. My apologies, the version I'm using here has not got that update as yet. So what does the question require us to do? To calculate the gain arising as a result of the takeover here in July 2015, July 15, and then the subsequent sale of the BPLC preference shares in March 2019. Now here it is critically important that we're very organised in terms of our approach. So let's see what is going on in the question and then get our approach sorted as to how we deal with this, firstly at the time of takeover, and then subsequently should any of the shares acquired at the time of takeover be sold. Here obviously some BPLC preference shares are being sold at that later point in time. But let's look at the problem. Z Limited acquired 10,000 A Limited shares in August 89 for a cost of £10,000. So we're dealing with Z Limited, who had originally bought 10,000 A Limited shares back in August 89 for £10,000. But then what happens? In July 2015, B plc takes over A Limited, and for each share in A Limited, Z Limited receives. Now remember, we own 10,000 A Limited shares. We get for each such share 2 B plc ordinary shares, valued at £1.50 each. And also for each of the 10,000 A Limited shares that we own, we get 1 B plc preference share, and that is valued at £1 each. Before you go on and deal with the disposal of the preference shares, let's now start the working that we need to do. And for this, we'll look through to the answer. But it's very simple. You are going to list out, at the point of takeover, what are the market values of the shares you have received in B plc. Firstly, ordinary shares, and then preference shares. So what did we have? 10,000 A Limited shares. For each such A Limited share, we received 2 B plc ordinary shares. 10,000 times 2 is 20,000 shares, valued at £1.50 each. 20,000 at £1.50, you put that in to your market value column. You will have 2 columns on the right hand side of this working: open market value and cost. You now know, in terms of ordinary shares, you would show the working 10,000 times 2 times £1.50. You have got a market value of 30,000. You then do it for the preference shares. Same 10,000 times 1, probably don't need a calculator for that, times how much are they worth? 1. You probably don't need a calculator for that either. So the market value of the preference shares, 10,000. So a total value of £40,000. Why do we need this? Because what we were originally told was that the 10,000 shares in A Limited there had originally cost £10,000. So you need to split that £10,000 cost of those original A Limited shares between the 2 things you've now received at the point of takeover: ordinary shares in B and preference shares in B. And what is the basis for splitting that cost? These market values. Well, if we go down to the lowest common denominator, I think we can see that 3/4 of the £10,000 will be applied to the ordinary shares. 3/4 of 10,000 will be 7,500. And of course, 10 out of 40, 1/4 of that 10,000, i.e. 2,500, will be attributed to the preference shares. It is entirely a share-for-share transfer. So back in July 2015, will any gain have crystallised? Remember the question: calculate the gain arising as a result of the takeover in July 15 and then the sale of the B plc preference shares in March 19. Will any gain have occurred at the time of takeover? No. Instead, the new shares, a combination of ordinary and preference shares, stepped into the shoes of the old shares here. The old shares had cost £10,000, and we have now allocated 7,500 of that to the ordinaries and 2,500 of that 10,000 to the preference shares. That sets up the base cost of their shareholdings, should then any of those either ordinary or preference shares be sold in the future. And that's exactly what happens. We then have a sale of the B plc preference shares. What does it tell us in the question? The preference shares are sold in March 19 for £15,000. Assume the index rise from August 89 through to December 17 is 1.357. There is the indexation factor. What we're able to do here, and we'll talk about this when we review the answer in a moment's time, is to ignore the takeover that occurred in July 15 and simply then, when any of the shares acquired, be they ordinaries or now preference shares, are then disposed of, here sold in March 19, we will apply the relevant indexation factor to the relevant amount of allowable cost, the cost figures that we had acquired here at the point of takeover. Now, again, I apologise that working is just a little bit messy. What it should be looking like is rather more like this. There's the working. Our BPLC ordinary shares, our BPLC preference shares in relation to the original shareholdings held. We'd had 10,000 shares. We get 2 ordinaries valued at £1.50. There's your 30,000. We get 1 preference share for the 10,000 shares we'd held in our original company. They're worth 1. 10,000, 40,000. Use that to divide out that cost, equals 7.5 equals 2.5. Were there any gains arising at the time? No. The terms of the takeover were a share for share transfer. No gain will arise at the time of the takeover, with the new shares in BPLC taking on the same original cost as the old shares in A Limited. That was 10,000. But of course, as 2 types of share are issued at takeover, we use the market values of those shares as the basis for dividing the A Limited share cost. There again, that £10,000. Hence the ordinary shares have taken 30/40ths and the preference shares 10/40ths of that £10,000 share cost. Now, we know that when dealing with a corporate shareholder, that on any chargeable disposal that occurs where a gain needs to be computed, that to compute that gain, we need to compute and deduct indexation allowance. It wasn't a problem that we had when dealing with individuals. So, in reality, the same method of apportioning the index cost column, so you could have been told here what the indexation factor was from when the original shareholdings had been acquired. Let's just remind you of that. When the original shareholdings was acquired there by Z Limited in A Limited, August 89, through to the date of the takeover, July 15. And what you could then do, you'd work out what the total index cost of those shares were, and again split in exactly the same proportions, 30/40ths, 10/40ths there, between the 2 shareholdings. And that would have meant at July 15 that you had both a cost figure and also then an index cost. If, for example, that index cost figure that you had here, I'll just make a number up, was say £24,000, when you reindex the 10,000 from when acquired through to the date of takeover, that 24,000 would again be split 30/40ths, 10/40ths there, and 3/4 and 1/4 24 would be £18,000 and £6,000 respectively. And those figures, as of July 15, would go into a new share pool for the ordinary shares and separately for the preference shares. So on your ordinary shares, for example, you would have 10,000 times 2 equals 20,000 shares that were deemed to have cost £7,500 and which at July 15 had an index cost of 18,000. You could then deal with any future disposal out of that shareholding. For your preference shares, you would have 10,000 times 1 equals 10,000 shares held, deemed to have a cost of 2,500, and with this number anyway, deemed to have an index cost of 6,000, again at the date July 15, and that would start up a new share pool for those shares. From that point on, should there be any disposal, you would reindex the respective share costs through to, well, probably not the date of disposal, because I guess the date of disposal is going to be now in 2019, 2020, maybe 2018, but certainly post the 31st of December 17. So any indexation, as you know, is frozen at December 17. Historically, what they've done in terms of exam questions, to the extent that we've seen the answers to these exam questions, of course, and the questions themselves, that though in reality the same method of apportioning the index cost column for the A limited shares would be applied and re-indexation of the index cost column would occur at the time of the takeover, that's what I've just explained, as well as at the date of the subsequent share sale. In our UK Tax UK, don't know why I've got two of those, one of those will do. In our Tax UK exam, however, this has been simplified. We do love it when the examiners simplify things for us. Very good news. As shown here, with an indexation factor being supplied from the date the A limited shares were acquired through to the disposal of the BPLC preference shares. So let's have a little look at what we have to deal with. When was the sale? March 2019. What are the proceeds? £15,000. What is being sold? All of the preference shares. So what have we got? Sales proceeds, £15,000. All of the shares are being sold. All of them are being sold. So there you go. All of the cost is now used. If half of these shares were being sold, half of that cost would now come into the gains calculation. And we now apply the given indexation factor. We know that indexation factors will be provided to us. In this question, I've given you the only indexation factor that you needed. Let's get rid of that, which was from August 89, when the original A limited shares were acquired, through to December 17. This disposal is taking place in March 2019. We can't, of course, re-index through to March 19. It stops at December 17. What was the indexation factor? 1.357. So, what is our cost? 2,500. What is our indexation factor? 1.357. Multiplied out, hopefully, that is the correct number, which therefore gives rise to our chargeable gain. Of course, going forward, you'd still own the ordinary shares, and when they are sold, what will their cost be? That will be the other £7,500 that we'd established there at the time of takeover. So very important when dealing with such a question to get your head around the chronology, the timing of what goes on. Often what you might get in a question here is that you are told that in March 2019, here, going back to the question, in March 2019, Z Limited disposed of its preference shares held in BPLC for £15,000. So you know the proceeds. So you then expect to see somewhere the cost of those shares that you can then index through to December 17 and then calculate the gain. But of course that is when they then tell you how those shares had been acquired. That Z Limited had not originally acquired any preference shares in PLC. Now they tell you the history. Z Limited originally acquired 10,000 shares in A back in August 89 for £10,000. Then in July 15, what happened? Then there was the takeover. So before you can deal with the object of the question, the sale of the preference shares, you've got to deal with the takeover. So you go back, look at what you originally acquired, look at the terms of the takeover, and you do, let's go to a clearer picture of this working here. This is the working that you now do, where you list out what it was you received in the way of BPLC ordinaries, BPLC preference shares. Get their total market value as well as the individual market values, and use that as a basis for splitting your original share cost. Once you have those figures, should you then have, as you do here, a disposal of any of those shares in the future, here it was all of the preference shares, you know the cost. If you know the cost, get your indexation factor. It will probably be up to December 2017, as the disposal of those shares is happening now, probably in 2019 there. And as soon as you've got your indexation factor, you can work your indexation allowance, and therefore you can work your chargeable gain, as we have done down here. So go back to the very beginning. What did you originally acquire at what cost? What were the terms of the takeover? How many ordinary shares? How many preference shares? What were they worth at that date of takeover? Establish the market values and use those market values to split out the original shareholdings, original share cost. Once done, should any of those shares, be they as here preference or possibly ordinaries, be sold, as long as you know the cost, you can put the cost against the proceeds, get your unindexed gain, apply your relevant indexation factor to your allowable cost, and you've now got the chargeable gain figure. Job done. Okay, pause now just to have a little think about that and rework through the example and the answer to make sure you are indeed content with the way that we've dealt with it before then rejoining us. And we've just got one final thing to do in this session, and that is to see whether at the time of takeover, what would have happened if maybe some cash had been received. Because if you receive cash, then that means you've got money in your pocket, and HMRC will want some of that money, because a gain will have crystallised if you've received cash, and therefore we've got to compute the gain. And if CGT, or here chargeable gains in terms of corporate tax, is to be paid, then it will be paid. But what happens then when we get cash as well as shares at the time of takeover? More of that in a moment, but pause, make sure you're happy with this before we go through to the next and final part of this chapter. Okay, let's finish off this chapter therefore dealing with this final little issue here, note D, and that is that if at the time of takeover cash is received, then a chargeable gain will need to be calculated at that date of takeover for the cash element received. See example 5. Down to example 5. Using example 4, what difference would it make if Z Limited receives at takeover? Again, as we had before, 2 BPLC ordinary shares valued at £1.50 each, and instead of 1 preference share valued at £1 in BPLC, we get £1 cash for each share in A Limited. The index rise between August 89, so when V Limited originally acquired its shares in A Limited, the original shareholding, and again, apologies for the wrong date there, July 15, which was the date of the takeover, and that is 1.275. Again, go back to the original point of takeover. What did we receive? We had owned 10,000 shares in A Limited. We received 2 BPLC ordinary shares, so 20,000 shares at £1.50. That is still 30,000 market value. We're going to list out these market values, of course. We also got £1 cash for each share in A Limited. We had 10,000 times £1 is £10,000. So again, you'll have £30,000 worth of ordinary shares, and this time, instead of £10,000 worth of preference shares, £10,000 worth of cash. And that, therefore, will now allow you to compute an immediate gain that arises at that point of takeover. So you repeat the same working as we had before, not a difficult working. As Z Limited now receives some cash at the time of takeover, an immediate gain will arise, computed as we see here. What did Z Limited receive at the time of takeover? The 20,000 BPLC ordinary shares that were valued at £1.50 equals 30,000. We got cash. We had 10,000 shares in A Limited, times £1 equals 10,000. 40,000 in total. Use that to split the same original cost of your original A Limited shares. That was £10,000. So what have we now got? You've got a receipt of cash of £10,000. That goes into your gains calculation immediately. You've got cash. This is an immediate gain. Therefore, the company is going to be taxed on it. Your proceeds are 10,000. What is your cost? There it is. There is the cost allocated to the cash element of the consideration at the point of takeover. Once you have your cost figure there, then based on that cost, apply the relevant indexation factor. This date of takeover, July 15, is before December 17, so we apply the relevant indexation factor. Compute and deduct that indexation and bring yourself down to what hopefully, numbers permitting there, will be your chargeable gain. That will happen at the time of takeover back in July 15. Going forward, what do we now own? We own 20,000 BPLC ordinary shares that are deemed to have a cost of £7,500. A cost incurred back in August, was it 89? Back in, yes, there we go, August 89. Deemed to have been incurred back in August 89, and should there be any future disposal of those shares, you would re-index that cost of 7,500 from August 89, when it was incurred, through to either the date of disposal, if the date of disposal was before December 2017, or index it to December 2017 if the date of disposal was later. You've got your cost, you've got your indexation allowance, deduct them from your proceeds, you get your chargeable gain. Thank you very much, job done. What you've got to remember to do, however, is to deal with things in the correct order. You can't immediately deal now with the disposal of some shares acquired as a result of a takeover. You must firstly deal with the takeover. Understand what the cost components were for the consideration that you received, and then know that either the share for share rule would have applied in the case of shareholdings, or in the case of cash, an immediate gain would have crystallised by putting the market value of the cash, i.e. the cash received, against each share of the allowable cost of your original shareholding. Okay, take time again now, please, to revise through and make sure that you're happy with those particular rules. What I'd then like you to do is to go back to, I think it was chapter 12, when we dealt with CGT for individuals, and specifically look at three areas which form the majority of the next and final chapter that we have to deal with in relation to chargeable gains and corporate tax. So before we deal with chapter 21, I would like you to go back to chapter 12, look at what the issues were, the principles involved in dealing with part disposals, dealing with part disposals, dealing with chattels, and also dealing with wasting assets. Because those principles, if you know them from chapter 12 and when we looked at CGT, those principles haven't changed. We use the same principles in chapter 20. The only new thing we have to deal with the availability of indexation allowance. But I'll expect that you do know the principles. Those have been already taught to you back in chapter 12, so make sure you revise that before moving on, please, to the next chapter.